right. Hey, everybody. Happy New Year. Dan Russo, Portfolio Manager at Potomac. Really excited that you all could join us here live. Before we get started, I am just going to put this out there. Here in New York, it is blowing at about 50 miles an hour, and my house is currently running on a generator. So if you lose me, that is why. However, I have some capable hands with me here today. I'm going to have Tyler Lovingood come on board in place of Manish to talk to you all about our year-end S&P price target and how we got there through fundamental analysis. Actually, for those of you who know well, I'm kidding. We are going to go through some of the key charts and trends in the marketplace that we think are most compelling, and I will leave you with some thoughts and ideas on what I think are the most important themes for you to be paying attention to here in 2025. For those of you who have been following our work closely, you might recognize it. And for those of you who are new to our work, it will be new for you. Hopefully it's a little bit thought-provoking, however. The charts that made you look in 2024, myself and Tyler will basically be going through a live episode of our old show, Who Charted? And that's what we're going to do. Just kind of walking through what's on tap over the course of the next hour. We are going to talk about what are the trends in the market, how healthy those trends are, and intermarket confirmation. Everybody who knows Potomac knows that these are kind of the three pillars to our process. The inputs that go into our composite models, largely speaking at a high level, can be bucketed into these three categories, right? What's the trend? How healthy is the trend as measured by market breadth? And is the trend confirmed by intermarket themes? And then from there, we like to touch on volatility, largely because it becomes a hot button issue from time to time. And there's some elements and dynamics playing out in the volatility space that I do think are interesting. So we want to touch on those. And then, as I said, we'll leave you with what I think are the most important charts for 2025, not my year-end price target for the S&P. And we will leave some time for Q&A, which I believe you can type into the chat, and we will try to get to as many of the questions as possible. But before we get started, one of the things that I love to do when I have a group of people is run some polls. Always like to get interesting data, whether it's useful or not, who knows? But what is your outlook for the S&P 500 for 2025? We're not about prediction, but it's always interesting to see what people think. Flat to up 10, up more than 10, flat to down 10, or down more than 10. And
are you going to reveal your answer at the end, Dan?
My answer? I don't make predictions. We know this. I put other people on the spot.
Probably down 30. Doomsday Dan.
No. I would never say something like that. Come on. Well, looks like we're not going to have a very big sample size.
One answer. It was probably Christopher.
It could have been. All right, here we go.
Look at that.
People probably joining Menti and logging in. We'll give this a few minutes. I don't know, Tyler, what's your prediction? Since we don't make predictions, but
yeah, I don't know. It's tough, and S&P never really gets its average, something we were talking about the other day. Correct. People like to quote this 7, 8, 9% average, depending on what time frame. But S&P really never gets it. So it's usually something like last year where we saw plus 20% or higher, or 2022 minus 18%. So you never know. You just could be an outlier year. It could be pretty quiet, but it's hard to make that prediction. I'd predict.
Yeah, which is why we don't bother doing it. So we'll give these a few more minutes, another minute for this one. And I do have another question, which I think is actually more compelling and more thought-provoking and interesting, quite honestly. So let's give this one another 30 seconds. Get them in. Time's running out.
No bears.
No bears at all. Down more than 10%. 0.0. Small sample size, not sure what to make of it. Let's move on to the next question, which I think is actually more interesting. what is your biggest concern for 2025? And I kind of pre-populated this with some go-tos that we've been hearing about. One, inflation, geopolitical risk, valuations. We're hearing a lot about valuations and the S&P 500 being expensive. And then U.S. economic and or fiscal policy. So let's see how these come in.
It's an interesting slide. You know, when I was thinking about it, how everyone was so scared, honestly, of all four of these things into 2022. And then after 2022, probably was focused on the first two and possibly the fiscal and policy risk. But turns out that the fears didn't matter. We just go up, just keep buying, apparently.
Yeah. And I think a lot of time, listen, I think a lot of these polls will bear it out that you're going to uncover everybody's recency bias more often than not. I think that if we put this poll up in the beginning of 2023, inflation probably would have gotten a lot more votes. Geopolitical risk and fairness is not super fair. Like that's kind of a broad topic, but not surprised to see that one get the most votes, and not surprised to see economic fiscal policy risk get the second most votes. Obviously, we have a transition of leadership here in the US. So this is not surprising to me. And it kind of played out the way I want it to for reasons that we'll get to later. But for now, why don't we just go through the charts? Here's what we know now, right? We can ask all the questions we want. We can try to make predictions, right? Futile task. Here's what we know now. Let's start, as we always do, with trends. What is the market's trend? And undoubtedly, the market's trend is up, as we're going to bear it out. But we'll go through the kind of the key markets.
We're going to start out with S&P 500, pretty steady uptrend above the 60-week moving average. Is that bullish or bearish?
Yeah. So, I mean, obviously, that's bullish. And it's one of the key metrics that we look at is kind of the intermediate to longer term trend of the S&P 500 above a steadily rising 60-week moving average. It's kind of hard to argue that that's anything but bullish from a trend perspective.
Right. The next one, NASDAQ 100, everyone's favorite, most of the Mag 7, which we'll see in a second. Pretty steady uptrend. What do you think?
Yeah, again, I think this is interesting. Obviously, this is bullish, right? If you own the NASDAQ 100 or if you own funds that are benchmarked to the NASDAQ 100, this is a bullish trend. Up and to the right is good. 40-week moving average, roughly equivalent with a 200-day moving average. Sliding higher, that's obviously good. And this is where most of the generals live, right? And by generals, I mean the mega cap companies that drive our markets. Now, if all you do is own the indexes, then it's fine. It's not really a concern until it becomes a concern, really. But for people who are more interested in stock picking, the fact that the next slide looks the way it does probably causes them to take an overall bearish view. And we can go to that next slide now. Next slide is essentially the generals, the Mag 7 here. And this is the top chart is an equal weight version of the Magnificent 7 with its 200-day moving average, Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Tesla. Obviously bullish up and to the right, but more importantly, I think, is the relative performance breaking to new highs as well. So this really is an environment where the generals are leading and they're doing a lot of the heavy lifting from a performance standpoint. And we'll touch on this a little bit further when we get into the health of the market. But from a performance standpoint, the top 7 stocks doing well is fine, as long as, let's call them the soldiers, are also participating. And we'll get to this a little bit later, but we're starting to see some changes out there that if you really wanted to start to make a bear case, you could. And now I'm not going all doomsday Dan on anybody, but we'll get there. Bear with me. Next up, I like to look at
small caps. And I was just going to say, Russell 2000 has been such a dog, really, relative to the S&P 500. And I remember back in November 2021 watching the breakout and getting all excited because, as you can see, that spike there in 2021 on the relative chart. But that lasted for about a week before a 32% drawdown, and it's lagged ever since. So what's your take, Dan?
I mean, from a holistic portfolio standpoint, this is a drag, right? It's nice as a market participant and somebody who's kind of paying attention to the market broadly, like a market of stocks. I think that this is nice to see as I have it on there. Right? You want to see all stocks doing well, right? If we contrast this with something like 2018, 2019, and into early 2020, where the NASDAQ 100 and the S&P 500 were moving higher. And you can see here, this was going sideways. And pretty much every other equity market that you could track was going sideways, right? That's not a great look. That's not a great environment. So we want to see the Russell 2000 doing well. I mean, if you think about what the bottom half of this is, it literally is the most trash bag companies listed. So the fact that this can be trading at or near all-time highs as the year comes to a close is interesting. Now, if you're thinking about it in terms of what is it doing for your portfolio, it's hard to make a case that it's doing much of anything. To your point, Tyler, it's been a massive underperformer for going on 3 years now. And, just kind of looking back at this chart on a relative basis, it has added zero value to portfolios since about 2004. So 20 years of adding no value on a relative basis. So it's nice to see, but it's hard for me to get excited.
It's a hard point too, whenever the correlation to the S&P is pretty high. I mean, if you're going to replace this with a portion of the S&P, you're getting killed on performance historically, and the correlation's not helping you much. So overall, Correct. It's been a drag.
Always speaks to kind of why we disagree with the view that you should build strategic portfolios and buy and hold. And I think the next slide will be an interesting testament to that. This is the S&P 400, and I ask if it's overlooked for a reason, and I kind of know what the answer is. It's overlooked largely because nobody really cares that much about mid caps, right? Small caps are kind of sexy. Everyone's looking for the next big thing. And then of course you have the monsters. And then there's this group of 400 companies in the middle of the S&P that nobody really pays attention to. And the relative performance here is an absolute disaster. There's no doubt about that. So buying and holding something that replicates or is benched to the S&P 400 is not that great. Now, up and to the right on an absolute basis, fine. But interestingly, when we test out different indexes through our composite models, we're using the model as a signal, the S&P 400 actually tests pretty well for our tactical way of trading. So I think it's important. Relative performance is obviously important, but you can look at something that has poor relative performance if you were to buy and hold it, but still kind of can be useful tactically. So I think that this is overlooked largely because, I don't know, maybe it's like the Jan Brady of the market, right? The one in the middle, and I'm probably dating myself there a little bit. But the relative performance has been a disaster, and that's largely why it's overlooked. But, from a trading standpoint, it does become interesting.
And, with all of these charts, we're looking at 10 plus, in some cases, 20, 30-year charts that are so long-term on a week-to-week basis. There's opportunities in these markets potentially for different things. And if you're tactical, then maybe you can take advantage of that. But as a strategic portfolio, it's a different question.
You should understand where your drags are. And I think the next one is going to be my biggest pet peeve in the market. All right. This is international ex-US. So rest of world, from the viewpoint of a US domiciled investor. And this is my biggest pet peeve because I read constantly and I hear constantly about how you have to have some token allocation to international for quote unquote diversification reasons. And I always push back and I say, well, if you had just this token allocation to international, it has been a drag on your portfolio for a decade and a half. Now, again, this is a nice to see a choppy path up and to the right, but look at this relative performance against the S&P 500. It is a disaster. And I can't even comprehend how anyone could justify having like a long-term strategic allocation to something that looks like this. A decade and a half of underperformance, massive underperformance. And it's a huge pet peeve of mine because people are constantly saying, well, you have to have some. And you hear the argument a lot. Well, the US is only 25% of global GDP, but most US investors have a massive allocation to US stocks. Good. They should, at least based on this. Now, if that changes, being a little bit more tactical will allow you to add international exposure as those trends change. But I don't know. I don't know how you make the case.
And it would be one thing, looking at the chart, it'd be one thing if the drawdowns happened at times when the S&P or U.S. stocks in general had their bear markets, but they don't. 2008, 2009 on the left side, the latest being 2022, 2020 in there. Major drawdowns in international stocks have happened at the exact same time as U.S. stocks, so they haven't provided any diversification benefit either. And a quick trivia question here for Dan is, since 2008, when this fund started, when is the last time it outperformed the S&P 500 over a 3-year period?
Well, I mean, I don't know the answer actually, but just kind of looking at this chart, it looks to me maybe, I don't know, 2009, 10?
October 2011.
October
so 14
2011.
years since any sort of sustained outperformance. So your biggest pet peeve is getting reinforced there.
I mean, yeah, I think that doesn't surprise me, I guess. And if you kind of think about what the world has looked like coming out of the global financial crisis, it's been largely an easy money policy and a declining interest rate environment that favors growth companies broadly, tech companies specifically. And if you look at rest of world, right, take Europe, take Latin America, take parts of Asia, not all, they're essentially underweight tech, broadly speaking. And that accounts for a huge part of the underperformance. So it is my biggest pet peeve because I don't think you should ever just have an allocation to something just for the sake of it, right? I think being more active and tactical adds value over time because you don't sit with this for a decade and a half.
Right. And like Cliff Asness of AQR just wrote about, maybe this is a different conversation in a few years.
Maybe it is. I hope it is. Listen, nobody wants to see this outperform or at least do better more than me. Like I think that, I mean, I studied international finance in business school. I think it's super interesting to have the entire world as your investment universe. And I think it would be interesting to have those opportunities and look for, other countries or other sectors in different countries that are doing well and could provide a level of diversification or, lower correlations. It hasn't made sense to go there. And to your point, they haven't helped you. When your drawdowns ex-US happen at the same time as they're happening in the US, like walk me through the diversification pitch. I don't get it.
Fair enough. Let's move to market breadth. So we got pretty established that US stocks are in healthy uptrends. Internationals have underperformed.
But still in uptrends. In fairness, I mean, I don't want to beat up on,
right. Fair enough.
Fair.
So let's see if there's just the Mag 7 that's dragging the market higher. So we're going to start out with the NYSE advanced decline line. Was in an uptrend for about a year. Looked good on a stochastic basis, but now it's starting to break down. So is this bullish or bearish?
Yeah, first, for those of you who don't know, we pay attention to stochastics a lot within our work. I think they're a good way to see where things are currently relative to where they've been. So in this case, the 1-year stochastic is simply measuring where is the advanced decline line now relative to its 1-year range. So if the stochastic was at 100, it would be at a 1-year high. If the stochastic was at 0, it would be at a 1-year low. And what's interesting to me, and to kind of get to your point, is it just the Mag 7 dragging things higher? For most of 2024, it was not, right? This line bottoms in October, the black line, the advanced declines, bottoms in October of 23, and is in a steady uptrend for, I guess, about 14 months. And through much of that time, the stochastic is above 80%. So the advanced decline line is in kind of the top 20% of its 1-year range. And then all of a sudden, in about mid-December, kind of late December, actually, market comes under pressure. But more importantly, a lot of stocks started to go down, right? In a healthy market, we expect to see more stocks going up than going down. And that's what we had through much of 2024 until about the last 2 weeks. And that's carried over somewhat into the early days of 2025. But, I say for 2024, we had a really healthy trend. And early days of 25, there's a storm brewing. I kind of asked the question, but I think there is a little bit, right? We've started to see a sustained move below the 80% level on the 1-year Stoch, and a breakdown in the trend. So maybe you see it differently, Tyler. I don't know, but this is early stages of something to be concerned about.
Yeah, as far as the point about is Mag 7 dragging everything higher, I looked earlier that for 2024, you would expect, if that was the case, QQQ, NASDAQ 100 would significantly outperform the S&P 500. But that really wasn't the case. They were, I think QQQ was only up a little over 1% more than the S&P for the year. And if Apple, Nvidia, and such was dragging the market higher and everything else was declining, then you would expect that outperformance to be significantly more. But
Correct.
It wasn't.
I believe that. I mean, notwithstanding the fact that there's massive overlap, right between them. But I think your point is valid.
So let's
all right,
get
what else
into,
do we look for in healthy trends? If the trend is healthy, we would look for more volume to be trading in the stocks that are going up than the stocks that are going down. And so far, this is okay. All right. So far, this is fine. Steady uptrend. Nothing to worry about here from a breakdown standpoint, but it is kind of walking the tightrope of the trend line. Now, the trend line is not super scientific, right? And in our work, obviously, we would be more, we quantify this a lot more. It just doesn't look pretty on a chart. The simple fact of the matter is you can see here, right, with overlaid with the S&P 500, this in a healthy bull market, more stocks go up than go down, and more volume trades in the stocks that are going up than going down. So far it's okay, right? The takeaway here should not be, Dan's about to go all doomsday, because I'm not. But I think for those of you who were at our Remix conference, I stood on stage and I was really bullish. It was September 30th of last year. I was really bullish, and I was really bullish the year before that as well. If I was standing on stage today, those trends are still bullish, but these things would concern me. Some of what we've seen so far from a breadth standpoint, what we're going to continue to see. So moving on to the next one, I think. So these are NYSE new high list, right? And there's some damage here as the year ends, right? For most of the year, we were seeing on a day-to-day basis a good amount of stocks making new 52-week highs, right? So again, if the trend is healthy, we expect to see more stocks going up than going down, and we expect to see more stocks making new highs than making new lows. And thus far, the NYSE new high list was fine throughout much of 2024, and then completely fell off a cliff to end the year. And start of the new year, it's kind of mid, as my kids would say. But perhaps more importantly is this one, right? Not a great look to close the year as new lows spike. And we had some days where the spike in new lows actually got near 9% of NYSE listed stocks, right? So you do not want to see a sustained level of more stocks making new lows than making new highs. You don't want to see sustained breakdown in the advanced decline line. Now, spikes in this metric throughout 2024 were sporadic and did not stick. Right. So that'll be the key going forward. I have no idea how it's going to play out, but this was not a great look to close the year. And, kind of as always, I don't know, Tyler, what do you think here actually? I can give you.
Well, I was going to say for seasonality fans too, look where the spikes happen. It happened during a Santa Claus rally period where historically stocks have done well relative to the averages. So we've got a spike in new lows at a time when stocks are supposed to
go up,
perform well.
Suppose.
So if that's a warning sign, it might be. But as we always say, you probably want to try and quantify that to some degree.
Correct. And we do. For those of you who follow our work, we include seasonality.
So moving to this NYSE stocks and long-term uptrends, and we define uptrend in this chart by being above the 200-day moving average.
200-day moving average, right? And I think that this is interesting, right? Again, because this is not explicitly used within our models, but it's kind of adjacent to, it's a breadth metric, right? In a strong bull market, you'd expect to see a lot of stocks trading in long-term uptrends. And now look what happened through most of 21 and leading into the down year of 2022, right? You have that arrow showing you clearly, right? And then we rebound coming out in October of 22. And then for almost all of 2024, this metric was above 50%. More than half the stocks listed on the NYSE trading above their respective 200-day moving averages. But you kind of have to squint a little to see it. But in December, when we saw a spike in new lows, a fall off in new highs, we started to see more stocks going down, we actually dipped below 50%. And now we're hovering right at that level as the new year starts. So tick below 50 in December, something to be mindful of. We start to see a sustained breakdown here. Now, it's not a great timing tool, as you can see. It started to break down in kind of mid-21, right? And the S&P 500 actually made a new high in the early days of 22 before completely falling out of bed. But obviously something to be mindful of if we're monitoring the health of the market.
And it's interesting too that the advanced decline line is up in near highs at this point, or is starting to break down. The volume ratio is also still relatively close to the highs, but this is starting to break down below the 50 level. But it can take time, like look in 21, where it took months before this broke down and stocks broke down. So these things just take time. And especially for a 200-day moving average, it's such a long-term measure that stocks will slowly start to lose their uptrend before it might be reflected in the indexes.
Yeah, I think, again, timing matters, depending on what you're trying to accomplish, right? We could have changed this to stocks above their 50-day moving average, and it would look a lot more like an oscillator. You could probably build some sort of trading model, or if you want to get even more sensitive, you can use the 20-day moving average. But kind of for purposes of looking at the intermediate to longer term health of the market, I like to stick to the 200-day. But as you all know, we love to play with data. So we have looked at, above the percent above 20-day and percent above 50-day as kind of oscillators for trading. And we've tested that stuff out as well. So
let's pivot into Intermarket. Now, why don't you explain before we get into it what we mean when we say Intermarket?
All right. So intermarket analysis is a form of analysis where you study different markets to get a read on the market that you care about, right? So you care about the stock market, but you pay attention and study what's happening in the commodity markets, what's happening in the fixed income markets, and even within the equity market, you pay attention to how different industry groups and sectors are playing off of each other, right? So I think the most famous form of intermarket analysis is probably Dow theory. Over 100-year-old concept where paying attention to the industrial companies and the transport companies to get a read on the health of the broader market and therefore the economy was a way of doing things. Interestingly, it's a 120-plus-year-old concept that we riff on. We do incorporate the trends in the transports within our work. And obviously, we pay attention really closely to what's happening in the interest rate markets. So what we're looking for is some level of confirmation, about the health of the market from trends in other asset classes. Probably the best way to describe that.
Right. And your note on Dow theory puts us to the next slide of the transportation average. So even though I think you wish it was the semiconductors replacing this in a modern Dow theory, what do you think on this? bullish or bearish?
I guess it's neutral, right, in fairness, but my biggest issue here is that it's been neutral for 3 years. This is the Dow Jones Transportation Average with its 27-week moving average, and it's gone nowhere. And we want to see this doing well with the broader market. That would be an intermarket confirmation. And we started to look good in early to mid-November. We get this breakout to new highs out of a 3-year consolidation, only to hang out there for a couple of days before falling back to the moving average and into the range. So it's not a great look. It's not the worst thing in the world. It's not falling out of bed, right? It's not a downtrend, but it's not a great look. And we'd like to see it moving higher, but right now it's not really doing any damage.
S&P 500 growth versus value. And this is a ratio line. So growth on top, value on bottom. If value underperforms and growth stays flat, remember this is a ratio, so the chart will still go up. So if this line is up, growth is outperforming value. If it's down, value outperforming growth. So what do you think on this one?
I mean, if you're a growth investor, this is bullish, especially if you're being measured broadly against the rest of the investment universe. What I think is interesting here, again, it speaks to the point of, is it just the Mag 7? And what you'll see is coming into 2024, the correlation here on the bottom is 6-month correlation of this ratio to the S&P 500. So as this ratio goes, so goes the market. And I think that that's becoming true again. This gets highly correlated to the S&P, and it gets highly correlated to the S&P in times where it's the monster Mag 7 type stocks that are doing most of the heavy lifting. Now, for the most part, we came into the year with this correlation fairly low, right? And that coincided with our advanced decline line moving to the upside, coincided with, most of the year, more than 50% of names in the NYSE being above their 200-day moving average. We had a healthy market. And now we are getting into an environment where, from a breadth perspective and now an intermarket perspective, it's not as healthy as it was, right? And I think that this is key to pay attention to, because what will happen is, just as what happened in 2022, if it plays out in a similar fashion, when they come for the generals, there's not enough heft underneath to hold the market up. And I think that becomes a concern. I'm not saying that's what's happening right now. It's clearly not, right? We saw the trend of the S&P. But when they come for the leaders, there's nothing there to help it. And the leaders have gotten so big that only a little bit of pressure on them can exert a fair amount of pressure on the index itself.
And something on this chart, most recent. So if you look at the far right side of the chart, it's a pretty big spike as far as outperformance on growth. But the S&P Value Index had its worst stretch in history with 14 red days in a row. So it was down 14 days, second to only 8 days in a row in 2018. So it's not necessarily that growth is flying higher and it's super risk on, although they did have positive performance during that stretch some, but value just kind of fell apart, 14 down days in a row. And maybe that's too far. And so we get some sort of a rebound, a reversion back the other way at the beginning of the year.
Maybe it could be. But yeah, no, we actually wrote about that. As a lot of you may know, we do a weekly that comes out on Mondays, and we touched on that. I think at the time it was only 12 days in a row. So I think it went on for another 2 to the downside for the S&P 500 value index, but 14 days in a row down. That's pretty brutal. So high beta to low volatility is something we pay attention to get a sense for risk appetite. And this doesn't scream risk on, right? If you think about it, if you're in a healthy risk-taking mood, you would expect high beta stocks to outperform the low volatility names pretty handily, kind of like we did into the early days of 2021, right? Coming out, especially, right? If you look at the left side of this chart, look at that massive spike. October, November timeframe of 2020, the market went on an absolute heater, and people were, as you recall, everybody was just sitting home looking to put risk on, and that's what they did. And the high beta stocks really ripped in that regard. And subsequent to that, we've kind of now gone sideways for, I guess, about 4 years. So from a trade standpoint, I don't know what you would there's nothing really to do here. But I do think that this is interesting when people say that, we're in an environment where people are just, I don't know, they're buying dog with hat or Dogecoin, and that's the type of environment we're in. I don't think it is. I don't think that bears out. I think you probably have a small circle and a small echo chamber. Is there some speculative excess? Yeah, sure there is. But is it widespread speculative excess? I don't think so. Not based on this chart.
Discretionary and staples. So now, before you get into it, I want to say it's equal weight. So both of these sectors are on equal weight basis, and that's probably because discretionary has a 21% allocation to Amazon and 17% to Tesla, and the next largest is only 6%. So if we did cap-weighted sector indexes on here, it would be heavily skewed. So
it would be,
which is bearish.
Yeah. So from an analysis standpoint, we use equal weight to normalize for the fact that Tesla and Amazon, you thought they were tech companies, everybody, but they're not. They're actually consumer discretionary companies. Why do we care about discretionary and staples? I like to pay attention to it. It's not explicitly part of our models. I like to pay attention to it because if you just, discretionary companies make the things that you want, right? And the staples companies makes the things that you need, right? And if you're in an environment where the things you want are doing better than the things you need, think a new iPhone, right? And what goes with it, right? Think about, you're just hitting Amazon every day as opposed to, soap and toothpaste, right? Think of it that way. In an environment where soap and toothpaste are outperforming, that's probably not a great looking environment from a market and economic standpoint. In an environment where the wants are outperforming the needs, that does scream risk on. So it's kind of interesting. Like, I guess my takeaway here is through much of this is it's kind of a mixed bag, right? Like I said, on September 30th, I stood on a stage and was pretty bullish. And now I think the environment's become a little bit more mixed, right? High beta going nowhere relative to low vol. That's a mixed message. And then you have this ripping to the upside, right? You have beautiful trends across most equity markets, and then you have breadth starting to fall off. So I think the key takeaway so far is that it's more of a mixed bag, right? I think it's harder to have massively bullish conviction. And mind you, nobody in our poll said down 10% or more. That's not my call, but just putting it out there.
All right, let's pivot a little bit to the bond market, starting with the 10-year treasury note on top with a 10-year yield on bottom, both in the 40-week moving average.
Yeah, so you would obviously expect these to be mirror images of each other. The top is price, the bottom is yields. And I think this is where most confusion is going to play out this year. And I think that look at the trend in the 10-year yield and the 10-year price. We've basically gone nowhere for 2 years. And through that time, we have seen, I guess going on 3 years now. We've seen a rate hike cycle. And now we're in a rate cutting cycle. And the yield has really gone nowhere. It's kind of whipsawed. Now, we do use yields as part of our process, right? So we want to see trends one way or the other. We want to see trends. Whipsaws are kind of just a not fun environment for anybody. And that's exactly what you're seeing. You're seeing the yield oscillate around the 40-week moving average. You're seeing price do the same. So I think where the potential for trouble this year is interest rate themes, in my opinion. You have a view there?
Yeah, everyone knows the issues of bonds now, at least traditional bonds such as treasuries, because of 2022. Every allocator pretty much got burned. 60-40 had its best run, I think, ever leading up to it. Everyone got burned where stocks and bonds declined together. And just out of curiosity, I looked, and the last 10 years, the U.S. aggregate bond index has had a negative Sharpe ratio and a total return of 14%. So the question I would ask any allocator is, why do bonds just get an automatic shoe in and they don't get scrutinized like other parts of the portfolio? So that's kind of a setup question. And that I would ask myself if I was a strategic long-term allocator.
Yeah, I think it goes back to everything that we kind of talk about and believe here, right? A strategic allocation to anything just doesn't make sense for us. A zero sharp, right? Over the time frame that you were looking at. I mean, that makes no sense to me. Meanwhile, right, if you're willing to be a little bit more tactical and think a little bit differently, there are pockets of the bond market that, I mean, high yield bonds close the year near all-time highs. Now, for those of you who are wondering, these are highly correlated to equities, right? So if you own equities and high yield bonds, you're probably not as diversified as you think you are, right? But again, I don't think anyone's making the case for you should build a 60-40 portfolio of S&P 500 and high yield bonds, right? I don't think anybody would do that. But the point is, you have a beautiful trend here to the upside, right? Contrast that with the 10-year yield, right? The safe asset that everybody uses for diversification, and it's been a burn. So the fact that high yields have been just within the fixed income space have been a great trade for, I guess, about a year now, maybe more. And I just think it's interesting, right? I think it's interesting in light of the next slide, because all we hear about is debt, right? All we hear about is ballooning debt, and the country has a lot of debt. It does. People have a lot of debt, maybe. And we hear that, credit is going to be a problem. Well, nobody is telling the credit market that credit is going to be a problem. This is credit spreads, right? So, these are the difference between high yield bonds and treasuries, and they are trading on their tights, right? The lowest levels you've seen, going back, 25, 26 years. So generally speaking, if there are issues within the credit landscape, this starts to move higher. You can see the massive spike leading up to 2008, right? And what's interesting about this is, unlike the VIX, right? If you look at a VIX chart, which we will, it looks very similar to this. But unlike the VIX, this tends to move ahead of events, whereas the VIX is coincident. So credit spreads are tight. So I don't know, the bond market is not telling you much. So again, getting back to that mixed bag.
But it's a hard thing to time too. So like if you look at 2007, 2017, 2018, 21, it can stay low for quite a while. But
correct,
it is a significantly mean reverting chart here. Like if it's at high levels, it's probably coming down pretty soon, same as a VIX would. And if it's at extremely low levels, the next move is usually up. The problem is you can
it's not a great
timing
tool. Much like the VIX. The VIX is not a great timing tool. And we have friends who've done a ton of work on that.
Which leads us.
All right, let's talk about volatility a little bit. We like to pay attention to volatility, largely because it's informative, and also largely because I think it's misunderstood. So why don't we start with the VIX? And the recent spikes may be a warning, right? Back in August 5th, I believe it was, there was a massive print in the VIX. Actually, in pre-market derived trading, some people are saying it went as high as 65, but in actual trading, it was only about 40. And then more recently, we had a spike to the high 20s. Now, why is that interesting? Well, because we haven't seen spikes like that in a while. And we also have not come back down to the lows, right? The prior lows. Notice that the second spike all the way to the right of the chart played out from a higher level. So again, running for cover, probably not, but paying attention really closely, I think you have to. I think that, the VIX, a 17 VIX is fine, right? When the VIX is hanging out in the 20s, that's not a great look, right? And you can see that that's where it's spent a majority of 2022. But we want to be mindful of this potential upside drift that we see playing out in the VIX. Now, what I will say is this. The next slide will show you that whatever fears are incorporated in the VIX are actually already priced into the market. Now, let's walk through this quickly. This is the S&P 500 with its 21 and 63 average true range percentages. Average true range is simply how much does a stock move day to day on average, including gaps, right? And if we think of it in volatility terms, the average true range is what the market has done, what it's realized, right? And we all know the VIX is forward looking, right? So The VIX is forward-looking or implied volatility, and the average true range is backward-looking or realized volatility. Now, a little math geek question here or a volatility geek question. There is actually a way to take the VIX and use it to back into what the market is implying the daily moves in the S&P 500 will be for the next month, right? And for those of you who don't know, if you take the VIX and divide by 16, which is the square root of 252 roughly, you can back into what the market is implying the S&P will move day to day for the next month. Now, if you recall on the previous slide, the VIX was around 17. If you divide 17 by 16, you get a number that looks like 1.06, right? And the average true range, 1.07 on the 21-day average true range. So the market is implying a 1.6% move per day, and the market has been realizing a 1.07% move per day over the past month. So elevated VIX slightly, okay? Actually priced into the market, it seems to be. You have a take here?
No, not too much. I mean, VIX is interesting, and things can change very quickly, like you saw on the last slide. I mean, we haven't had a 10% pullback in quite a while, but if we do see one, or when we do see one, VIX will spike, and this will all change pretty quickly. Now, with a 21-day and a 63-day look back on these ATR percentages, they'll lag a little bit because they're averages. So over the last 21 days, the average daily change was 1.07%. So it'll take some time.
Yeah, I think I'm looking at it more as like a messaging tool, saying, the VIX, there's nothing abnormal happening here, right?
Right.
Everything's kind of in line. The market is looking for 1.06% moves per day, and we're getting 1.07. So it's fine.
Right. But the bond market, on the other hand, has been pretty volatile.
This one bothers me. This one actually bothers me, again, because so many people set up portfolios and they just default to bonds as their diversifier safe asset. Well, this is the MOVE index. And for those who don't know, it's the VIX for treasuries, right? If the VIX is looking at equity volatility, the MOVE index, created by Harley Bassman when he was at Merrill Lynch, measures treasury bond market volatility, right? And we saw that this trend higher through 21 and into 22, right? And 2022 was the year that the bonds did not help you. And what's interesting to me is that this has not mean reverted to the downside the way you would expect. And it bothers me because this is the volatility of the quote unquote safe asset, everybody's safe asset. And it's not coming in. The vol's not coming in. It's just kind of hanging out here. I think it's something to be mindful of. And this is all kind of building up to what I think is going to be important. So it's fascinating to me that bond vol has not come in because sure, 2022 was a horrific year for the bonds, right? But 23 and 24 were okay. 23 was better. 24 was kind of a push, right? But that vol is hanging out there. So here's what I believe are the most important charts of 2025. And they're all related to this next one. Inflation. So some of you who have been following me know or may know where I'm going with this. But the simple fact of the matter is we are still, in my opinion, in an inflationary environment. And this is fascinating because if we go back to what was the major concern for people, our poll, only one of you said inflation. Only one. And I think inflation is actually the biggest risk to the market. Everybody thinks it is a foregone conclusion that inflation is done, that we're going back to 2%. And I think that if investors are wrong about something, it's this, and that will show itself through interest rates, right? So go back to your 10-year chart of choppiness, and it will show again in that MOVE index remaining elevated, right? So this is the consumer price index. It's hanging out above 2%. Now we've come in from 9%. That's great. But I don't think the move to 2% that everybody thinks is going to happen is necessarily going to happen. as cleanly as
And
they do. And
to a
you've done
point
the
here,
work here.
Dan.
Why is 3% important?
Yeah, I was going to say there's two real reasons I think that this can cause a lot of problems, and the second being what you just point out. But the first, being a person at Easterling, did a lot of work on long-term cycles, and anytime inflation moves away from stability, so moves away on the upside or the downside from about 2%, which is the target, it causes a lot of problems for the stock market, which we saw obviously in 2022. And the second reason being when inflation is higher, when it's an inflationary environment, the stock bond correlation changes significantly, which we also saw in 2022. So it causes a lot of problems, which leads us into the stock bond correlation.
Yeah, so I think that we're probably one of the groups of people that have made this thought process famous over the past few years. But simply put, inflation is the driver of interest rates, and inflation is the driver of stock bond correlation. So CPI above 3% starts to force this correlation positive. You saw it play out. Everybody was baffled in 2022 that the bonds didn't help them. This is why, right? And what you'll see here is these move in cycles. There's a long cycle where stocks and bonds were positively correlated, followed by a long cycle where they were inversely correlated. And in fairness to most people, the cycle where they were inversely correlated corresponds to most of our careers, right? Most people do not know an environment where stocks and bonds don't move in different directions, where bonds do not provide the diversification, hedge, and benefit that they're there for. It doesn't have to be that way. It's not always that way. Inflation is the key driver. 3% on CPI is the level where it starts to get really interesting, and it cuts both ways, right? A positively correlated stock and bond market can be great if both go up 2023. However, in an environment where stocks go down, this positive correlation acts as a double-edged sword and hurts you as well. So the point is, and the reason I think that these are the most important charts for the year is because if we do see a turn higher in inflation, we have a pretty good job market and we're cutting rates. So not out of the question, in my opinion. Stock bond correlations will become more positive or could become more positive. And that has portfolio management implications that,
Right.
like, I think that the odds of another year like 2022 are higher than people think. And that's not a bad thing. I'm not saying it's a bad thing. It doesn't mean we crash. It doesn't mean everything goes down. The point is they move together. And that's not why they're there. That's not what a diversifier is, right? Like they're diversifiers should be things with low correlation to the thing you're diversifying. Fair?
Yeah.
I think we're pretty adamant about this. We've spoken about it a lot. And I think it probably becomes an issue again. Or I think the potential for it to become an issue is undervalued in the market by most investors. I mean, just go back to our poll. Only one of you said you were concerned about inflation. And I'm sitting here telling you, I think it's the biggest potential concern. And as of right now, the bond market seems to think that way as well. The bond market certainly does not believe the Fed. These are the Fed funds rate in blue on the right scale and the 2-year yield in black on the left scale. And what we've seen is the 2-year yield does a good job of front running the Fed. You see the 2-year yield start to go higher ahead of the Fed tightening cycle. And then it goes sideways ahead of the Fed stopping. Yield starts to go down ahead of the Fed cutting. But now, ever since the Fed started cutting, this has pretty much done nothing but go up. So the bond market is sniffing something out. Now go back. Choppy 10-year. Move index high. I think these are the 3 most important charts of 2025. And the biggest potential risk that's the most underappreciated. It's not meant to scare people. It's not a call. I think it's a thing nobody's paying attention to. And with that, unless you have something else to add, Tyler, I'd love to open it up to Q&A.
I think we're good to do it.
If you do have questions, I think, Christopher, we're having those typed in. Any questions, comments, concerns? No. Tyler, you have any questions?
Not unless you're going to tell me where the S&P is going to end next year.
No, big letdown. No S&P price target. All right, everybody. Thank you for carving out some time to be with us today. I hope you found this helpful. Thank you to Tyler for stepping in last minute and helping MC this. And Happy New Year to everybody. I hope 2025 is a good year for all of you. And as always, we're around. Don't hesitate to reach out to us for questions, comments, concerns, or just to say hi.
Thanks, everybody.
Thanks, everyone.